Good afternoon, everyone, and welcome to our November webinar. My name is Jonathan Howard. Our topic this month is a great one. We brought in two special guest speakers, two wizards of Wall Street, who are going to reveal their strategies for success. A couple of quick housekeeping items. Here's a disclaimer to be aware of, and a couple of program notes. Now, normally our webinars are about 45 minutes. This one is going to be a little bit longer, probably about an hour, maybe an hour and 15 minutes. There's so much content and so much strategies that our wizards wanted to share that we couldn't contain it in a small one. So we've got 60 minutes long. Everyone asked, will the webinar be archived? Absolutely. It'll be available on investors.com in about 24 hours. And because there's almost 3,000 people live on the webinar, unfortunately, we cannot answer all your questions live, but we will do a review of all the webinar questions and answers. It'll be posted on investors.com/wizardsqa. Now, all of the ideas, all of the screens, all of the charts for today's webinar will be hosted by our product called MarketSmith, which is a comprehensive stock research platform. It can help you find ideas, analyze technical and fundamental data, and more importantly, show you when to buy and sell. And our market wizards are super users of MarketSmith, and we'll walk you through how to do it. For those who aren't going to make it until the end, we want to let you know there is a special offer available. It's 4 weeks for $24.95. Give us a call, 800-831-2525, or go to investors.com/wizards. So without further ado, let's introduce our webinar moderator, Mr. Rusha Pierce. He's the director of MarketSmith and also a product coach. Good afternoon.
All right, thanks, Jonathan. Good afternoon. Okay, so welcome, everybody. This is a great day for a webinar right here. And so I want to introduce our first special guest, Mark Minervini. He's a U.S. stock investing championship veteran of Wall Street for 35 years, the founder of Minervini Private Access, and was featured in Stock Market Wizards. He's also written a couple of great books, Trade Like a Stock Market Wizard and Think and Trade Like a Champion. Hey, Mark.
How are you doing, Arusha?
Good, good. Thanks for joining us in this webinar. Now, our second guest is David Ryan, three-time winner of the U.S. Stock Investing Championship, former client advisor and product developer of William O'Neill & Company, former portfolio manager in-house here for William O'Neill, and also the New USA Growth Fund, and also the founder of Ryan Capital Management. Now, David has been, as you've all heard with the California fires, David's been affected by that, but he has overcome all odds to join us today. So, David, thanks so much. Welcome to the webinar.
Arusha, thank you. It's so nice to be on this call, and I look forward to doing it. It should be a lot of fun.
Okay, so let's go ahead and get started right here. And so this is what we're going to cover in today's program. We're going to go over and make sense of the current market. We'll go over how these market wizards trade with an edge. And after that, what you should look for in a stock, what these market wizards look for when they're analyzing stocks. Then we'll go over how to find winning stocks, and then finally, we're going to do a live chart breakdown. So let's get started and just go over the current market and try to make sense of this because it is a tricky market. So here's a snapshot. I took this snapshot probably an hour and a half before the close, and it actually rebounded from here. And so I'm not sure where it closed, maybe halfway on this, but we had a fall-through day on November 7th, but as we can see, that fall-through day isn't working very well. Guys, any comments on this?
Yeah, well, we did have a follow-through day, and the market trading below the 200-day right now, and the 50-day in a downtrend on most of the major averages, and then of course we had some distribution take place within a few days right after the follow-through day. Not on the NASDAQ. The NASDAQ actually, the volume was a little lower, but when you take a look at the NYSE volume and compare it to the S&P 500 or the NYSE index, you'll see that we did have it. Now, that doesn't necessarily mean that we're going to go to lower lows and we're going to have to go and revisit the February low, but it's certainly more ominous than if we didn't have a distribution day there. So now we just have to watch and see how the market acts over here in the next several days and weeks to come here.
Yeah, and the other thing I would add is on that follow-through day, you got you got lower volume, lower than average daily volume on the S&P 500. You did get a pickup in volume on the NASDAQ, but that was a sign that it might fail. When you get a follow-through, you really want lots of volume, and you want it on all exchanges. So that's a key in looking at the follow-through day. The other thing to look at is how weak the NASDAQ is relative to the S&P 500. It's really been underperforming for about 4 or 5 months, so money might be moving elsewhere and out of the NASDAQ and some of the more tech-heavy NASDAQ stocks.
Yeah, real quick, Arusha, just to make a follow-up on Dave's point of 2 things. One, the best follow-through days have real powerful thrust. You like to see 9 or 10 to 1 or greater up volume versus down volume. If you look at the NYSE volume, we did not get that. Also, as Dave pointed out, the NASDAQ's underperforming. It's heavily weighted in these FANG names, and they're late stage, and it looks like there's a rotation here, and you're probably going to have to look for new leadership going forward. FANG names are probably going to be market performers going forward.
Okay, so yeah. Let's go on and how the market wizards trade with eggs. Now, here's the thing. Professionals always have a plan. They lay out that plan way before the trade. So you plan your trade, then you trade your plan. And so you're going to see throughout this presentation, these two are always planning well ahead of time, not in real time. And so, guys, let's walk through just some of the basics of how you initially plan your trades.
Right. So we're going to always have a precise entry point that we know exactly the price we're going to get in, how far we're going to maybe chase that stock, or not chase the stock is a better way to put it. Not chasing the stock too much beyond a proper buy point. So there's a precise trigger that we're going to know, and also we're going to know our risk before we ever even get into the trade. Exactly where I'm going to set my stop loss. Dave's the same. He's going to know exactly where he's out before he ever gets in on the risk side. So we're already quantifying that risk. As a matter of fact, I'm going to back into the trade based on that risk. And then, of course, you have to manage the trade based on your risk versus reward.
Yeah. And a lot of this, there are times where I track stocks and I've got their entry points set. And it might not happen in the next day or two, but sometimes I'm tracking stocks for weeks or if not months, waiting for that exact setup to happen. So it's not something that you rush in real quickly. It does take planning to set that buy spot, and then also immediately or even before you get into the trade to set that spot of where you're going to be getting out.
Yeah, and let me just follow up on one thing also. When you're doing your work and you're trying to find these entry points, using MarketSmith and conducting your screens, I like to do it the night before when things are calm and quiet. The next day, I've already laid out my plan for the day and what I'm going to be looking at, the stocks that are set up and are ready to move through buy points. The thing that I would really encourage people to avoid is not calling audibles, meaning making a last-minute decision. In the middle of the day, you see something on TV, you read a story, and all of a sudden you're making snap decisions that you didn't really do much planning on. That's for the night before. Run your MarketSmith screens, get your stocks that are set up, set the entry points, and then stick to that plan the next day. Don't call any audibles in the middle of the day.
Yeah, one last thing. What that does is that eliminates the emotion, and that's what you always want to achieve on every in and every out of a stock, is you want to remove the emotional decision. It should be all cut and dried.
Exactly.
So let's illustrate this concept with a trade. Now, Mark, you traded this. This is your trade, all right? And so here's Shake Shack. So now the first thing that I wanted to highlight here is pattern recognition. So I'm hovering my mouse over pattern recognition. And so you can see it identifies a coupled handle there. So that U-shaped green line right there, and then you have a little dip. That's pattern recognition. That's all computer generated right there. That's all on MarketSmith, and it automatically just puts it right on the chart for you. And so it's really laying out that plan right for you. So Mark, why don't you take us through your thinking back then when you saw Shake Shack setting up this pattern.
Right, and Margaret Smith did a great job of outlining here a textbook cup with handle. You can also turn that on and off. If you don't want to have that pattern recognition, you can turn it on and off. So, but it did a great job of recognizing this. So the buy point here is at 44.40. As it moves through there, that's where you want to enter that trade. And then, of course, my stop was a little bit below the low in that handle there. It wasn't a little bit lower than the actual low there. I had a pretty tight stop on it, and the stock just came out of there, perfect. This is just a textbook setup, a textbook cup with handle setup.
So Mark is buying here. Now here's really the next step that market wizards look at. It's not just buying the stock at this point. It's managing your expectations, understanding how a great stock should behave. So guys, why don't you walk us through what you expect after buying the stock?
Yeah. So,
Mark.
Yeah. Well, Dave, why don't you talk about being in a profit right away?
Yeah, when I'm buying a stock, my expectations is that my timing is so good that stock should immediately go up. And the best stocks that I buy are the ones that I buy and I'm in a profit within minutes, at least by the end of the day. And then it just keeps on going. The best stocks are the ones that are almost hard to buy, and when they come out of their setups, they come out and they're up and they just take off and go. And the ones that really make the big moves usually have like 11 out of the next 15 days are super strong on big volume, and they're just off to the races. And it's hard to fill out the entire position.
Yeah, and the key is really to try to determine whether, when you get to these buy points and the stock is moving up, to determine whether you have retail buying or real institutional buying. And the difference is that institutions take time to build a position, and they're going to be in there persistently buying it. The stock becomes hard to buy, and you'll see they get away from you very quickly. If you don't buy it at the right point, very quickly the stock will get away, and next thing you know, you're looking at it going, oh boy, I wish I bought that a little bit lower there when it broke out. Now it's up 5-6% or so. So those tend to be the trades that work out the best. But want to also stress that it doesn't necessarily mean that it's going to happen every time, and the trade is a failure if it doesn't. Because one of the things I see now with people, everybody's got a machine gun in their hands now. They got the cell phones. They're over trading. So you do have to, and we'll talk about that in a second, but you have to give the trade also some room to fluctuate. But the best thing the best thing that can happen is that trade is at a profit as quickly as possible.
Okay, so let's go back to the Shake Shack example. So here's Mark buying it, and here's the expectation. This is what you guys expect, right? Up 4 out of 6 days on increased volume.
Right. I like to see 70% of the days over in the first week or two be on the upside. So in the very first few days to first week, I start counting the days. So if you look here and you count the days, you've got 4 out of 6 days are up. And then I also look at the closes. So I see there's more good closes than bad closes. A lot of closes right up by the high. So that tells you that the stock's acting well. You get a little pullback there. That's fine. The way you know if it's natural or not is if you see the balance of power is basically positive. So you're seeing more up days than down days, more good closes than bad closes, and then after a small pullback, and you got to let the stock pull back. If you're going to hold it for a bigger move, you're going to go through pullbacks. It should get into new high ground fairly soon, usually within a week or two. It's right back into new high ground after a breakout. That tells you that the stock is under some real accumulation, and you want to hold it for a bigger move.
And
the other, Arushan, the other thing I was going to point out too, that is even the stock took off and on 2 days were up big, and then it pulled back for 2 days. Look at the volume, how the volume was lighter than those up days. So just showing you that there was not much profit taking, not much selling as that stock took off. And the other thing that was, I think, very important to see is that the relative strength line went into new high ground as the stock was going into new high ground, confirming that strength.
So now here's the stock where you're buying at the buy point, you're up 7%. So you have a little bit of cushion going to earnings. One of the questions we always get is, how do you handle earnings? We know earnings are just so volatile these days. So Mark, why don't you start us off with this? Well, how did you handle this? You know, you're up 7% at this point.
So I had a cushion on it, so I went into earnings and I held into earnings on this one. Now, usually I'm only going to hold into earnings if I have a cushion, and that doesn't necessarily mean that I have just a cushion on the stock. Sometimes if I see a lot of stocks are working and I'm having a lot of success and a lot of stocks are reacting well to earnings, and maybe I backlog some profits and my trading's doing well and I'm up, maybe my account's up 20, 25%. I have some cushion. I built some profits in. I might start holding some, even if I don't have a big cushion. I might have a smaller cushion. Maybe I'm only up a few percent. But it's certainly if I'm entering from a cash position, for instance, now you have a correction. Maybe you're in cash. You're going to come back into the market. I'm going to be a little more careful. This just happened just the other day. Advanced Auto Parts, AAP. I own the stock. I looked at the indications. It looked like it was going to have a swing of 10% in either direction on earnings, and I was down actually about 1% on the trade. I decided to just step aside. Stock ended up gapping up 10%. In hindsight, it would have been good to hold it, but it could have went the other way too. So again, if I have a cushion, then I'll hold. In this particular instance, I held it right into earnings here.
And so you got the nice jump on earnings here. So you can see with the green shaded area with Market Smith there, identifying it's now 20% where you want to consider taking your profit at this point. And here's the final move at this time. So setting yourself up for potential moves like this is where all that discipline comes from.
Yeah, and then I sold some into that strength. I don't think it was on that exact day, but a few days later, then sold some a little bit later, as the stock moved higher. Using strength for selling, that's another thing that you're going to want to do as a professional. We're looking to sell into strength, especially if you're moving size. You have to get out when you can get out, not when you want to get out necessarily. When the getting's good. And another thing I want to point out that a lot of people forget what the goal of stock trading is. It's not to get the high or the low, because you're never going to get the high or the low. Okay, that's just a fruitless endeavor. The goal is to make more on your winners than you do on your losers, and do it over and over to make a decent profit. So when you have a decent gain, you're up 35% in 8 days, 10 days. You compound a few of those trades out. You can turn a pretty big profit in a very short period of time. And I can probably speak for Dave here as well as myself. When we won the U.S. Investing Championship, a lot of people say, "Now, how'd you get those big returns, and what were you doing? Were you doing anything different than you do now?" We didn't have big, giant winners. We were compounding trades like this, where you're picking up 20, 30, 40% in days to weeks. You don't have to do that too many times, and you have yourself a triple-digit return.
Yeah. The other thing I want to add to that last slide on Shake Shack is that when that stock gapped on earnings, look how huge the volume was. And also look at any time that stock pulled back as it was on its way to $70 a share, you usually had lighter volume, lighter volume. The red volume is the down volume. You had lighter volume than when it was moving up. Just a perfect sign of a stock that's acting well. It's always increasing on heavier volume, and it's pulling back on lighter volume.
Okay, guys. So let's go into a few more winning trades here. Let's start off with Canada Goose, ticker symbol GOOS. And so here's the setup here. You can see pattern recognition picking up a consolidation, but there is a little bit more detail within this. And so, Mark, why don't you walk us through the volatility contraction pattern that you're seeing here?
Right. So it's sort of become my signature. The volatility contraction is a characteristic. It's not a different pattern per se, but it'll be a characteristic of, say, a cup with handle. So I saw a lot of people misinterpreting cup with handle. So came up with this VCP concept to be able to have another way to explain it, so people could determine whether it's a consolidation that's a proper consolidation. So you want to see those pullbacks getting tighter and tighter. And on the right side, I like to see them in the single digits. You know, if I don't want to see a 15% handle, if you will. That's not a pivot. That's still, you know, enough volatility to be considered still in the basing stage. But once you get that pivot point, you get into single digits. Maybe it's 5%. In this particular instance, you can see it was 5% on the very right. It contracted 4 or 5 times. Now you're getting ready for that stock to be purchased as it moves through the top of that pivot. And you can also see, if you look down at the volume is very, very low in that pivot. And that's what you want to see, a total dry up of volume. I see stock not coming to market anymore.
Yeah. And then the other thing is, a lot of people say, well, how do you find these stocks? Is when I'm going through and I'm looking at hundreds of stocks, especially on the weekend, preparing for the upcoming week of trading, I'm always concentrating and looking at the right side of the chart. I'm always looking for those tight patterns. I don't have to deal with the rest of the chart until I find that something is tightening up on the right side. And remember, all these stocks that we're looking at, also you want to have it in combination with the other, you know, O'Neill Can-Slim characteristics, strong earnings, good consistent earnings, and things like that. But always key off of that right side tightness in that chart.
Okay,
right.
So then
and there's actually a screen. Let me just give you a quick plug for Market Smith, because there's a great screen that is a tight area screen where it'll actually bring up tightness in price, and that's something that you can look at very quickly and find a lot of tight price action.
So a couple days later, then Mark is buying here as it's crossing the pivot, and then if it pulls back a little bit, Mark, but you're not getting shaken out here.
Yeah, so I bought it as it came out. It's pretty textbook the way it comes out there. And again, see, this is an instance where, okay, so it has not followed through right away. Okay, so it's contradicting what we were previously saying. That we want to be at a profit right away. Okay, so this pulls in, but I've already set my stop loss. I'm not going to circumvent my stop loss just because the stock comes in a few percent. I'm still going to stick with that. Now, if I start seeing violations piling up, you know, over the next week or two, we're seeing heavy volume on the downside. There's more bad closes than good closes. Excuse me. There's more down days than up days, and they start to pile up. I might reduce my position. But again, you got to give stocks some time. You got to give them a little bit of time. Well, and I like to see, even if they don't break out right away, I'm okay with that, because sometimes, you know, there's a lot of eyes on a name, it runs it out real quick, and it comes out a little too hot. I'm okay with a quiet breakout, but I want to see it get back into new high ground within 1 to 2 weeks. That's sort of my time frame, sort of my time stop. If it's not working out in the first few weeks, then I start to question the trade.
And then a few days later, it reemerges into new highs, and this is where David's coming into the stock.
Yeah, and now the volume comes in.
Right, and and it's I'm not that far. I mean, it's just going into new high ground, and that's fine. The farther you get away from the buy point, the heavier your risk gets, and so you want to be as close to that buy spot as possibly as you can, because if you start getting more than just even a few percent, or I would maybe go as far as 5%, but that would be the absolute limit. Your risk starts increasing, so you want to be right there as it's going through that pivot point.
Okay, and so now it starts to act a little bit better, and then you have your kind of first pullback right back to the pivot. Now, a lot of people, Mark, you mentioned before the machine gun trading. This is where people are going to start getting shaken out here.
Yeah, well, I'll tell you right now, they'll get shaken out right away when it didn't work out right away. Where I first bought it, comes in for 4 or 5 days. That's good enough to knock people out nowadays. Everybody's got such a small time frame, and they're not willing to let a stock play out. Remember, your job as a stock trader is to anticipate coming movements and then wait until you're proven right or wrong. That's the part that people don't understand and don't fully appreciate, that wait until you're proven right or wrong. So you should already go into the trade knowing where your risk is. So, but what happens is then the stock starts moving around, and all of a sudden you forget that you've already made that decision, that you were, had acceptable risk. If you can't sleep at night and you're getting all nervous about the trade, you're probably trading too large. So we call it the pillow factor, sell down to the sleeping point, right? So you can adjust your position size. So that stop loss, you've made that decision already. Now, once the stock starts moving up, now you have to start reassessing, and now you're going to start protecting your line, protecting your break-even point, and at some point protecting the profit. But you got to give room, got to give stocks a little bit of room to fluctuate. Here, if you count the days here, you'll see there's 1, 2, 3, 4, 5, 6. There's like 7 out of maybe 8 or 9 days up. So it's acting perfect. It only came in for a few days. Remember, I said 1 week to 2 weeks. Within 1 week, it just shoots right back up. Volume comes back in. I mean, it's acting perfect. There's nothing wrong with this at this point.
Yeah, and you key off that supply and demand, and when the stock pulled back, and this seems to be happening more often in the last couple of years, where a stock breaks out and it pulls right back down on top of the previous base. And once it holds and starts turning back up again, you can buy that for the first time even there if you missed the initial breakout. But you want to make sure that on that day where it pulled back after it broke out, it closed. It looks like it closed mid-range, maybe slightly below mid-range, but the volume wasn't as heavy as that first initial breakout day. So, if it came back down into the base, and it did it on volume, then I would get a little bit nervous and probably be selling my position or selling part of my position. But the fact that it came down and it sat on lower volume and then started turning, that was a good test, and the stock should be off to the races after that.
And so then the stock...
Arutha, let me just give you just a tiny bit more granularity. So another thing, if you notice how when the stock drifts back, it takes 5 days, maybe this next time 6 or 7 days. But you see how quickly it gets back at the new high ground? That's what I call tennis ball action. That actually goes back to Bill Berger. Some of you who maybe are my age will remember Bill Berger. Bill Berger used to say he likes to buy tennis balls and avoid eggs. So this is tennis ball action, where you reverse very quickly. You're right back at the new high ground. That's another characteristic of a stock that's under accumulation, where it'll drift off 4 or 5 days, and then bang, 1 or 2 days, it makes it all up.
Yeah, and I would add that the natural movement of a stock that's in an uptrend is it moves up quickly, pulls back slowly on lighter volume, moves up quickly, pulls back slowly on lighter volume, and that happens over and over again. And if you continue to observe that, you stay with the stock. But if the volume starts picking up on the downside, heavier volume on down days, then that starts raising red flags.
Yeah.
And so the stock hits the 20%, and then once again, earnings time. But this one's a little bit better. You guys have a cushion at this point, so you've earned the right to go into earnings with more shares.
Right.
Yeah. I mean, once you're at a decent profit, you have options. You have a lot of options open up to you. In the beginning, it's all risk. You go into the trade with principal and risk. Once you're at a profit, you have the option. You can take your profit right there and nail down a good profit. You can sell part of it and free roll the other half. You can move your stop to break even and free roll the whole trade. You have your options open up. So that's where you start being creative with how you're managing the position at that point. In the beginning, there's no room for creativity. You buy the stock, it breaks out. If it hits your stop, you're out. That's it. Once the stock moves up, then you could be a little creative. Here, if you wanted to hold it into earnings, the stock's acting great. Again, if you look at the days, count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There's like 15 out of maybe 17 or 18. I'm not exact here, but something like that. Like 15 out of 18 days up. So and the stock is acting really, really well. So that could give you an indication that you might want to, try to hold that for a bigger move.
Yeah, and that number of days up is just a sign of institutional buying. They're in there every day. They can't fill out their position in one day, so they have to buy it over multiple days. And that's also a sign of there's probably a number of institutions trying to get that position at the same time, and that's why it's up that many days in a row.
And then we find out why later, right? It has a great earnings gap, and this ends up going up 54%. So, yeah, those are those possibilities. Those are those clues that lead to these kind of moves.
Right. And now the move is accelerated and it's too excessive. Now you're looking at, you're starting to see some signs that you should be selling and taking that profit. And this just goes right back. You could just go in my latest book, there's a whole section on selling. O'Neill's book will talk about exactly what's happening right here, where you have your largest day, your largest spread. Usually once you get that and you're extended, you run up, you climax, you have a climax run like this, you have your largest day, your largest spread. It's not too soon after that you get at least an intermediate term top.
All right.
Yeah, so, and yeah, I was going to just add at that top, you'll see that you got the largest down volume after it hit 68.75. It had 3 days in a row on the biggest volume that's traded on the downside in at least almost 3 months, and that was a sign that, hey, maybe things are starting to change. Then the stock started wedging for a number of weeks. See how the whole thing is now starting to change. It moves down fast, and it takes a long time. It takes 1, 2, 3, almost 4 weeks to get back what it lost in just 3 days. That's a sign of change, a sign of maybe the position, the stock is starting to top, and you're going to start a downtrend.
Right. The character is now shifting to looking like it's under distribution as opposed to accumulation.
Yeah, exactly.
So let's go into one more trade here with Ollie's bargain outlet. We'll just due to time, we're going to skip the Burlington story. We'll save it for another time. We hope to do another. We're going to probably do another webinar next year. But so we'll save that, guys, for that next webinar. Let's go into Ollie's, and then we'll get a little bit further down the line here. So here's Ollie's, and guys, why don't you take Mark? Why don't you take this out? You see a big cup with handle forming, and actually both of you were buying on this day as it emerged.
Yes. So David and I were both watching this stock for a while, and as a matter of fact, when David comes to my town, I have one near my home, and we've gone and looked at Ollie's. But Dave could tell you some more about the fundamentals behind Ollie's. But yeah, we were buying it. I started with a half position here. I wanted to see it tighten up a bit more. I thought it could still tighten up, but I wanted to make sure I had some position on it as it starts to turn up here. So I bought a half position. Dave bought his full position on the same day that I bought the half position.
Yeah, and new issues, and there is a new issue screen on MarketSmith, but new issues are usually sometimes the biggest winners. And you can see this came out. It came out in a tough market, and the stock went down initially, but formed a great big base of looks like over 6 months, and then came out into new high ground. Some of the best new issues actually come out in tough markets, and that's what this one did, and actually, tightened up on the right side there, and then took off. And look at the huge increase in volume that stock had as it was coming out, and how low the volume was when it was drifting off in the handle.
Right, and a few things to point out, Arusha. One is that, like Dave said, these can be some of the biggest winners, and the reason is, and I call them magnitude trades, these primary bases, your first viable base after a new issue. This is the earliest that you can get on board a company in the life cycle of its public life cycle. Now, that doesn't necessarily mean that the company is a new company. It's a new stock. For instance, Ollie was in business for many years prior. I'll let Dave, you could tell the story about the sales and the store closings, but
right.
This was a company that was around for a long time and had a long track record of operating the business very successfully. But this is the earliest that you can get on, unless you had IPO shares. And I never buy a stock on the IPO. I want to see some price action, and I want to get some technical price action before I'm going to buy the stock. Facebook, LinkedIn, a lot of these stocks come public, and they have to have huge corrections and sometimes take years before they're ready to actually make their move.
Yeah, in terms of the fundamentals that I would add, is that when I get to know a company well, I have a little bit more staying power in it when it has shakeouts and such. But on one conference call, they talked about how in 30 years they had never closed a store. And to me, that tells me they know how to pick locations and they have very, very good management. And that gives me the confidence to buy and stay with a stock for a long period of time. And the great thing about this and other stocks is that other great winners is that you usually have a number of buy points along the move, especially if a move lasts for a year and a half or 2 years. You'll get a number of different entries if you miss the initial base.
And David, that's a great segue for so I just put it the move so far for Ali. Mark talked about the magnitude trade, and you can see this here, up 315% from the pivot in 2 years and 7 months. So not bad, and it kept setting multiple times up too.
Right.
You had at least 4 opportunities to buy coming out of a base along the way there. So absolutely, this is but of course you want to look at companies that, number one, are newer names. When I say newer names, in the last 6, 7, 8 years, because most of the big winners are companies that haven't been around for more than about 8 or 10 years. So, and also companies that might be unfamiliar to you, that you haven't heard of. And everybody just, knows Amazon and Facebook and Google and Netflix, and these are what they want to own. But that's, when I was buying Amazon back in 97 and buying Netflix in 2010 and buying Cisco in 1990, you know what? Nobody heard of them. As a matter of fact, most people hated these companies. Everybody hated Amazon. For a long, long period of time, that Wall Street said they'll never make any money. So, and now everybody loves Amazon. It's like a bellwether. So you got to realize that at some point these stocks become yesterday's leaders.
Okay, so let's move on to cutting losses. And so let's just go over the basics here of cutting losses here. So Mark, why don't you take us through just why this is so important?
Okay, well, first of all, you're going to have losses. That's a guarantee. So you have to deal with them. And at some point, you'll have big losses if you don't take small losses. There is no other way. Between David, myself, Bill O'Neill, we've got, I don't know how many, years. I've been doing it for 35 years. Dave, over 40 years. We haven't found a better way. If there was a better way, believe me, we'd be doing it. But we haven't found a better way than cutting your loss. And options and hedging and all that adds risk. So that's not mitigating risk. The reason why an 8% number is so important is because at 8%, it basically takes 8% to break even. When you get to 10, it's an 11% move to get even. You get to 20, it's a 25, it's 50, it's 100. So it works geometrically against you. You can never let yourself have a big loss because it takes too much work to get back to even. So keeping those losses at 8% or less is very important.
Yeah, and I would add that any loss that gets greater than 8% is caused by rationalization. You start rationalizing the loss. You say, well, I know the company really well, or the CEO lives next door to me and he says everything's great. And you start coming up with all these reasons why you should stay in the stock. But the number one reason is that stock is at a loss and the loss is getting worse. And the other thing is that and all this takes is discipline and setting that stop loss before you get into the trade. You don't start, as Mark said, calling audibles and start doing all sorts of different things. But you set it beforehand and you stick to it so you prevent these losses from getting out of hand.
So let's go into a couple of examples here. So Mark, let's go over Habit Restaurants. And so this is where you were buying it.
Yep, as it came out here. And this was a power play, or what we refer to, Bill would refer to as a high tight flag. And this is, this is what I call a velocity trade. So you have the magnitude trade is the new IPO, the primary base setup. The power plays, the high tight flags, these are the velocity trades, the trades that can move up very quickly in a short period of time. When these work out, you'll generally, if you go back and you take a look at the ones that work out, they go up between 1% and 3% a day over anywhere between, 35, 40, 50 days and just in the first few months, and can make even much bigger gains. But you'll find that you get rewarded really, really well when they work out. So I'm always considering, the power play setup.
Now, in this case, though, it didn't work, right? Like many trades, but you have your plan.
Right. So just apply the same rationale that I was talking before. So here it breaks out. Next day, tries to follow through, reverses. Now, if you look at the first week, count the days. You've got 1, 2. You've only got 2 days out of 5 or 6 days up, right? And the stock comes back in, and one of the worst things that you can see is relatively low volume out and then high volume in. So meaning that you break out of the base, but then you come back in on higher volume that you came out. The only thing worse than that would be you came out on very low volume and then you had even really high volume coming in. But even if you have a good volume breakout, if the volume then is larger coming back in and you can't rally. See, this stock couldn't rally, and you see there's a bunch of bad closes. So it's just the exact opposite characteristic as we saw with the situations that worked out. So I'm out. I'm out right there. If it comes back in, I'm gone.
Yeah, and so this is why, right? These stocks can get much worse at this point. So, David, let's go into your trade here with Marathon Petroleum. And
right.
So you saw this coupled handle forming, and so you're buying here, and so you're just following your plan at this point.
Yeah, and the thing that the handle, lots of times when you go back, or most times when you go back on a losing trade, it's because it wasn't properly set up. And where I was buying here, it had a handle, but it really dropped down a little too much in the handle there, down to 76.22, and then it comes right back up. But the volume's not great on the breakout, and then about 4 or 5 days after the breakout, you start getting bigger volume on the downside, and it really actually broke out one day, and then you started getting distribution, and then it started chopping back and forth. It went into new high ground again through 85, but it can completely reversed on that one day, and also got some huge volume, and so then I gave it some time. But then when it came back down through my buy point and I started taking a loss, then out I went. But this is just the opposite of what you want to see on a successful breakout. You want that thing to keep on going for a number of days and not this chop back and forth with heavier volume on the downside.
You can also see, Arusha, real quickly, you can see how David gave this stock every opportunity to prove itself right or wrong. And like I was saying before, you don't just jump in and jump out because stock doesn't perform in the first few days or even the first week or two. So this stock broke out, and then it tried to consolidate a bit. It had one quick shakeout, zoomed right back into new high ground. Looks like, okay, everything's okay here. And then it starts getting a little volatile and squirrely. It's all over the place, and then it starts to act a little bit funny there and comes in. And now it's showing that the volatility is picking up and it's coming down towards his buy point and hitting a stop. But Dave's giving it the room. He's giving it the room until it's either a profit and he's going to shift to protecting his break even or start protecting his profit. He's sticking with that stop and letting the stock have some room to fluctuate.
Yeah.
Okay, so let's move through one more stock here. This is Twitter that Mark traded, and we'll move quickly through where Mark bought it. So yeah, Mark, why don't you just quickly just talk about what you're seeing here with this at this point?
Well, another stock that's a power play type setup. I was watching Twitter for a while. It finally got some legs and moved up, aggressively off the lows there and started setting up like it was setting up a power play type high type flag setup. So I bought it as it started to come off the lows there a bit. Because it's a widely followed name. I was trying to buy it as it started to turn up. I actually bought more as it confirmed and got strong there on that last day there, and I took a very large position. I was overweighted in it. So those are my buy points there. I scaled into it.
And in this case, it doesn't work, right? And so you end up round tripping this trade, and so you have to cut your losses.
Right. So there's another example of low volume out, high volume in. And just real quick, what I found, dealing with thousands of investors over the years, that the real $64,000 question for most traders, certainly beginning traders, is they spend so much time trying to learn how to get into the stock and buy the stock that once they're in it, they don't know what to do with it. What do I do after the trade starts to work? Do I sell it at 10%, 20%? Or what if it just sits there and it doesn't do anything and it's not really hitting my stop, but it's not moving? So in my most recent book, I lay out all the violations and confirmations. I know I talked about a few of them here, but there's 6 or 7 of them that I look for, and this is one of the most ominous violations you can have, and that is where the stock comes out on either low volume or volume that is then completely engulfed as the stock comes back in hard into the base. And you can see that's low volume out. I call it low volume out, high volume in. So now you come back in real hard. That's the biggest down day and a huge spike in volume. So I'm not going to stick around there. I mean, I'm lucky to get out of there at break even. That's what ended up happening. I ended up breaking even on the trade. But that's I'm gonna get out of there and wait till this clears, the smoke clears.
Now, here's one of the coolest things I learned from both of you guys. When both of you guys sell a stock, you don't immediately knock it off your watch list. You put it on another list that you look at still frequently, every day or every few days. And here's Twitter now, a couple months later, setting up a couple handle and potentially giving another chance to take a shot on it.
Yeah, I know Dave is, and myself, we both, when we sell a stock, even at a profit or if the stock stops us out, we put it on a sold list. And I look at it, regularly. I'll keep looking at that list, because just because the stock stops you out doesn't necessarily mean that the fundamentals have deteriorated. The fundamentals might actually improve, and it may take a little more time. You're maybe early into the trade, or it was extended in price and needed some time to correct. Maybe the market comes off a bit and it's correcting with the market. So, there's only so many names that you're probably going to be looking at. We're all looking at the same names. All right, you screen the market and you find maybe there's a few hundred names that have great earnings and great charts. It all comes down to timing, but I always look for a reset, and this was a perfect example where the stock then set up a nice little coupled handle type pattern here.
Yeah, I think the other thing that's important about what Mark said is that you should have no ego. You lost money in the stock once, and maybe you lost money in the stock the third time. You shouldn't be sitting there arguing with yourself when it sets up again and say, oh, I hate this company. I've already lost money twice. I'm not playing again. Usually that's the time the stock really makes the big move, and you're going to miss out. It's when you just have to, again, be disciplined, cut out the emotion, cut out your ego, and take every stock as it sets up. And if it's setting up for the third time and it takes off, you got to buy it again.
That's right. The first step is to be able to recognize how I like to put it is I like to play aces and kings and queens. All right. If you use a poker analogy, I want to play aces, kings, and queens. That's a premium hand. So now, does that mean that every time you're going to win with aces? No. All right. It's probabilities, though. Over a number of hands, you will win. You will win 70% of the time if you push all your money in on a game of Texas Hold'em pre-flop, heads up. You're going to win 75% of the time with aces, but you might lose a few times in a row with aces. So same thing, but first you have to learn how to spot aces. Once you learn how to spot aces, you should always play aces, even if it's the same stock. If it's setting up, you go back and you have to. The stock doesn't know who you are and doesn't have it out for you, I can assure you.
So, Mark, you sold it as strength here. I guess another valuable lesson that we all have to learn when trading.
Yeah. So it's acting really good. I mean, if you go and you look at, it's got a whole bunch of up days and only, I think, maybe 2 down days. It's acting great, but the stock is really hyperextended here. So I made a nice quick gain in a very short period of time. I figured at the very least the stock probably is going to have to, maybe rebase a bit. Maybe I could buy it back. A lot of times I'll sell part of my position. So I'll have a nice gain like this. I'll sell half my position. I'll move my stop up and backstop it, and then if it resets, I'll add back the half that I took off and trade around my core position. In this particular instance, I just decided to just take the money and run and hit it just a day off the high there.
Okay. Yeah, and Mark, one thing that you mentioned that's important is that too many people think they should be all in on a stock or all out of the stock, but so many times, I mean, almost all the time, we're buying incrementally and also selling incrementally as we're going into a stock, because we're just kind of, it's like driving a car. You see a yellow light, you start slowing down. It turns green again, you speed up and you start buying it again as the base is complete. So you're constantly adjusting the position for how the stock is acting.
Yes, so many people want to think in black and white. All right, investing is not an on-off business. It's a business of adjustments, of making incremental adjustments. With buying, you don't have to buy all at one price. You can scale in. All right, with your stops, you don't have to set a stop at one price. Sometimes I set a staggered stop, what I call staggered stops. So I might set a stop at, I want to have an 8% loss on the trade. So if I set a 6% and a 10%, I'm going to lose on half. I'm going to get stopped out on half my trade at 6, half at 10. I end up with my 8% loss, but I give the second half a little more room. So that's the only way I would ever exceed an 8% stop would be if I'm staggering the stops, but I'm still going to average that 8% at worst. And also, I just want to point out, you shouldn't average 8%. Your losses should be more in the neighborhood of 4, 5, or 6% on average. Your worst case scenario is your 8% stop. It shouldn't be your average.
Okay, so let's go into what you guys look for in a stock. So David, let's start off with you here first. So I would pull up a MarketSmith weekly chart. This is Ollie's Bargain Outlet. And so David, why don't you just walk us quickly through just what you look for with this weekly chart and just how CanSlim's integrated into it?
Yeah, remember, the CanSlim philosophy is designed into this chart. So you can go on this one chart and get all the characteristics you need. Down in the left-hand corner, the quarterly earnings, that stands for the C. You can get the annual earnings right above that and a few blocks higher, showing the earnings per share growth rate. The new is in the description. You can also see new highs in price as the stock is breaking out. Also, right up at the top of the chart, there's the market capitalization, the shares in the float, to see how big the company is, and also the S stands for supply and demand, and that's just looking at the volume in the chart as it's moving up or as it's moving down. And then leader or laggard, HAL stands for leader laggard. You can see the relative strength on this stock. On Ollie's right there is 97, so it's outperforming. And then I'd also like to point out that the line right under the chart, the blue line, is showing you how strong that stock is against the S&P 500. And then other things that are important is, the I in CanSlim is the number of funds. What kind of institutional sponsorship is that stock getting? And you can see that the number of funds in this stock over the last 4 quarters has gone from 434 now up to 517. So, and then M stands for market. So the great thing about this, the way it's designed, is you've got everything really you need in one chart, and you don't have to go looking all over the internet for this type of information.
And
yeah,
Mark,
if I could just follow up on that, Arusha, and just because I need to point out that, MarketSmith didn't just come to me out of the clear blue here, and I'm like, oh yeah, okay, we'll work with this company and start talking about their product. I've been a customer of MarketSmith and the predecessors, of course, Daily Graphs Online. Before that, the Daily Graph printed version, and seen this entire thing just evolve over 30 years. I've been a customer for 30 years. So to me, this is an absolute necessity. And I would point out that the problem now there's so much information. There's information overload now. People have so much information with social media and the internet that they have too much information. And the beauty about MarketSmith is that this is the stuff that you need to see is all put on the chart here the relevant data that's important based on fact, not on your opinion and what you think works. This is based on what actually works in the market. So I would, tell everybody to just get rid of all their, their free programs and all their stuff that they think, you think you're being cute getting free stuff, but in fact, this is the best money that I've ever spent in my life, is having these charts. These charts, this daily graphs online MarketSmith, without it, I don't know if I'd be able to do what I've done, because you just don't get all this information in one place. So, and we could talk about, how I look at this, break this stuff down also.
Yeah, so Mark, I know you could spend a whole webinar just on this weekly chart. So let's go into a few more details that you have learned over the years just using the product for over 30 years.
Yeah, there's so much data on these charts, and it's all you need. You don't need anything more. So one of the things, if we back up and we take a look at when Ollie's was actually setting up that perfect IPO base, it was also setting up something that I looked for. I always look at the earnings, the annual earnings. You can look at it on the weekly chart here. You'll see in that box on the left-hand side, there's the annual earnings. I always look to see if there's been a range that the earnings have been stuck in 3, 4, 5 years or more. And if you're going to break out of that range, now sometimes you already see the breakout. In this particular instance, you'll see 29 cents, 33 cents, 33 cents in 2012, 13, and 14. And in 15, it breaks out 47 cents. So what's that, about 40? Actually, that's about 40.
I think it was like 42%, Mark. Yeah,
42%. So you've got a 42%. That's a very significant earnings breakout. And institutions will key in on that. They have their computers set for earnings surprises, and they use regression. And when they break out of these ranges, they'll start looking at this. The difference is that as an individual, you have a speedboat, and the institutions they're running a cruise ship. It takes a long time for them to take these positions, and you can benefit from that because you have the ability to move very quickly on these, and you can see it right away. So you can see you get a breakout. This is what I call a breakout year. You get a breakout year here, and you see the earnings break out, and since then they've been accelerating. And sometimes you'll just see that there'll be an estimate of a breakout year, and that's enough to get my attention to start watching the quarterlies and to see if that's coming to fruition. So maybe 2015, 47 cents is the estimate, but that's showing that they're expected to have a breakout year. So now that's going to come on my radar. So that was one of the things that I was looking at back then.
Now, a few other things, the top 5 relative strength stocks right there on the weekly chart.
Yeah, so I'm always looking at the other. But yeah, go ahead. You talk about it, Dave.
Yeah, I would just say that when you're looking at a group or you're looking at a stock, it's always good to see what are the other stocks in the group. And this shows you the top 5 stocks. And I would concentrate on those top 2 or 3 at the most. Don't start going all the way down to the bottom of the group and look at something that has a very poor relative strength or poor earnings, because that is probably not going to catch up to the leader in the group. And so the leader in this group is either Ollie or 5 below. I mean, Dollar General has done very well too, but these are the 2 that have made really the biggest moves over the last couple of years. And that's where you want to do your you want to concentrate on getting into those types of stocks.
And you might find a name that's even a better name. You might find that maybe you've uncovered a name and you look at the top few relative strength names, and there's a name that even has more powerful characteristics.
And then we, of course, have the quarterly earnings and sales. But let's skip that for 1 second since we already covered that. Let's go to the timeliness rating. Mark, you had a great way to express this one and why this is important to you.
Okay, so I've been using the product for 30 years, and what I've found over 30 years is that virtually every bear market that I've seen, I think I've been through 8 bear markets now. Virtually every bear market that I've seen, the leading stocks that, in hindsight, that I saw lead the market, almost every one of them have timeliness ratings of A when they emerge. It's a great thing to look at. That list alone, just looking at the A timeliness rating stocks when you're in a correction, is a great list right there in itself. It'll bring up anywhere between, I think, 250 to maybe 400 names. Right now, you could be running that timeliness rating A and looking for stocks coming out of bases, and that's going to put you that's going to put you ahead of 98% of every other investor right there, because it's going to have the characteristics of big winning stocks. It's not going to guarantee your success, but this is a game of probabilities, and that's going to put you in the right direction. At least you'll be in the right direction looking at a qualified list of stocks.
And so now after you find a stock that's acting well, Mark, why don't you walk us through, that you mentioned the industry groups, finding some ideas. Why don't you just walk us through how you use MarketSmith to do that by using the related information panel?
Right. So once I find some ideas, maybe I find this, Ollie's, and I look at the top stocks. Well, sometimes there's, the group is a large group, something like maybe a semiconductor has a lot of stocks in the group. I like to use the panel on the right, the industry and sectors, and then you'll see it says view stocks and industry. You click on that, and all the stocks in that industry group will come up, and then it will populate the screening. I'm not sure what you call it on the bottom, but you'll see all those names. And then what I do is I can sort them. I can sort them by relative strength. I want to sort them by your composite rating or by earnings, maybe how close they are to a 52-week high. I can sort those and then start looking at the better names, and that gives me an idea of what's going on with the entire group. And so I love that feature. It's a great feature to go even beyond the top 5 stock window.
And so now let's going a little bit further here, because in the last 6 months, we've had a chance to work with Mark on improving and really incorporating his trend template. We always got requests from customers, hey, do you have Mark Minervini's trend templates? And so this was our opportunity. So we've been working with Mark for a number of months now, refining and really getting these trend templates, finding the stocks that he's looking for here. So Mark, right now we have 2 trend templates. We have the 5-month and the 1-month. A little bit later, we're going to introduce another one that's a little bit looser that gives you a little bit more flexibility. But Mark, why don't you walk us through the 5-month and the 1-month?
Right. So some of you that have read my first book will understand about stage 2 uptrend, and that I'm looking for stocks that are already in uptrends. I'm not looking to buy the bottom in a stock. I'm trying to find the stocks that are already in uptrends and have some momentum behind them. So this is what I call non-negotiable criteria. And up until this point, you weren't able to calculate this in any one place. You would have even at MarketSmith, you weren't able to calculate it. So they've added those variables in here where you can run a screen, and you're going to right away, it's going to meet the 8 criteria that I'm looking for, that the stock is in what I call the stage 2 uptrend. Any stock that doesn't make this cut, I'm not even going to see. So, it's great for discipline, because you might be tempted to buy some stock because, it's a big cap name, GE, for instance. I know a lot of people on Twitter are telling me, oh my God, aren't you tempted to buy, GE at $7 or $6? No, I'm not. I would never even see it unless, people, if it wasn't on TV, I'm not going to see it on my screens. So the 5-month trend template is simply looking at the a confirmed uptrend of 5 months, and that's pretty much 98% of all my trades are going to be are going to have this criteria.
And then the 1-month trend template, Mark?
So the 1-month trend template is simply the uptrend is just starting to turn up. If you want to try to maybe get a little head start and see. This works good with bigger cap names, also with the power plays and the high tight flags, because sometimes they just take right off the lows and they run up really quickly, but they set up before the longer term trend gets a chance to really get itself confirmed over 4 or 5 months. So this is another a shorter time frame trend template. And again, most of the trades that I make are going to be on the 5-month. But this is a good one to run also to look for those what I call an early turn.
Okay, so let's go over how to find these. Here's your MarketSmith chart. You want to go in the bottom panel, and then either you can click on the middle bar, the middle button right there, the half white, half black icon, or the black icon, and you're going to open up that list panel. And then it's really easy from here. When you look to the left-hand side, all you have to do is click on Reports, Stocks, Technical, and then there are your 2 trend templates, the 1-month and then a 5 month. So once you click on one of these reports, these are all auto-generated for you. The stocks are going to appear in that bottom panel right there. So Mark, now there's one other really cool thing that you can do here. You have that 5-month trend template. When I took this screenshot, it was like 221 stocks, but you can actually also screen off of this trend template. Can you walk us through that?
Right. So when you're screening in MarketSmith, you're screening from the MarketSmith database, which is thousands of companies. But you can narrow that down if you want to use the trend template. That could be your qualifier, what I call non-negotiable criteria. If it doesn't meet that criteria, I'm not going to trade the stock. So I don't want to see anything unless it's in an uptrend. You can add the timeliness ranking if you want, and look at those A stocks that are within the in those uptrends. So you would go up to the left-hand corner, select the trend template, and that would be the database that you would be screening from. So it would already screen everything out, and now you're going to add that criteria. Maybe you're going to add some earnings criteria or some other type criteria, or increase the relative strength. Maybe you want to only look at relative strength number of 85 and higher. So you can add that and now start narrowing it down. This helps you to narrow a list, a very large list of companies in a universe down to a very manageable number of names.
And so, yeah, you can see here I just added the EPS percent change of 20%, and we dropped it down from 221 to 99. So let's go over another way to screen with MarketSmith. So, David, both of you love using this, but David, why don't you walk us through the relative strength line new high? It's pretty simple right here, but it's very, very important.
Yeah, the relative strength new highs is it's actually looking at the relative strength line, and that line is versus the S&P 500. And when the market is in a real bad downtrend, I mean, this is a great market to use this screen, is that when the stocks that are holding that relative strength, that relative strength line will be hitting new highs. And so I do this almost on a daily basis when we're in a market like this, looking for those companies and even the sectors, too, that are holding well, because those are going to be the ones when the weight of the market comes off and it starts turning higher. Those are usually the ones that are going to take off and make the next big moves. Now, you might find utilities showing up there. Those I wouldn't consider as great candidates. But if you start seeing some growth stocks starting to show up there, names that you haven't recognized in the past that are showing up, start checking into them. Look at their earnings. Go through all the canceling characteristics, because that could be the greatest. Those could be the big winners in the next bull market.
Yeah, I particularly like to use the RS line new high screening function during corrections, because the market can be going down and a stock could just be going sideways, and it's increasing its relative strength. And you want to know which stocks are resisting. Those could be the leaders, when they finally break out. So it's very easy, a little box. You just check it, and it'll narrow down. It'll require that your stocks have to have a relative strength line hitting new highs. I wouldn't use this exclusively always, but particularly in a correction, it's a very good thing to look at.
Okay, and so then one more list here. The near pivot list is a really, really popular list for those who don't have as much time. Just quickly to walk through this one, all you have to do is click on the Stock Ideas button, and this little window is going to appear. And when you click on View, the stocks will appear on the bottom. Now, what this is going to do is it's going to show all the stocks within our MarketSmith Growth 250 list, setting up, all that are picking up patterns right now. And a number of those, they might have these cheat areas that Mark likes to look at, or maybe pullbacks and things like that. So this is a great list. If you don't have as much time, you can go from 300 stocks right down to the most critical ones. Right now, 24 stocks in the list. So it's real easy. We're using that pattern recognition technology to make things a lot quicker for all of us.
Yes, and doing a very good job of it, and you're starting with an already qualified list of the MarketSmith 250, which is already going to put you in a direction of having a lot of the characteristics already in place, and then this is going to give you the ones that are technically setting up. So a great list to look at on a regular basis.
Okay, so let's get into some live chart breakdowns here. So we ran the screens over the last couple of days. And so, guys, let's just go over a few ideas here of what you're seeing here. And so the first one we have is 5 below.
Yeah.
Go ahead, Mark, on this one. Yeah.
Yeah, I don't see the chart, but that's okay.
Oh, it should come up now. Did it come up?
I don't see it, no. It just says live chart breakdown. But that's okay because I actually have on my screen next to me, I have Market Smith. I know what it looks like anyway. So 5, the retail area, it's sort of fragmented a little bit. I was early into the retail area back, I don't know, maybe 6, 8, 12 months ago. And since then, retail's, done quite well. It seems like it's getting a little bit fragmented. Today we had a few of the names. You had Nordstrom, Kohl's, Target. Took it a little hard today. So it looks like the bigger retailers are starting to underperform a bit, but the discount retailers like Dollar General, Five, and Aldi, which we talked about, seem to still be holding up and setting up here. So Five is setting up. There's a look like a viable pivot here that's very close to being a buy candidate.
Yeah, and then on the next one, Sienna. This is very interesting, especially when technology is breaking down badly. This is something that's underperformed the market for a long time, and then recently it got a very good earnings report, broke out of a nice base. Looks like it's pulling back on a little bit lighter volume, and that's something to watch to see if it sets up another base right in here. But it's kind of bucking the trend, and it gets me a little bit nervous since there's a lot of money coming out of a lot of other technology stocks.
Yeah. This is again, you can see the 200 days just only been in an uptrend for about 4 or 5 months. So this would get picked up on that trend template, and just coming out of this base here, had a nice big move on the earnings. You see that right there. There's like 20 million shares, and as Bill would say, that's not your Aunt Betty. Those are institutions piling in there. So now. Through the correction, as we corrected here, this stock held up pretty good, and it's one of the very first to rip into new high ground here. So I would even be willing maybe to buy, as this is pulling back here, back near the breakout, buy it as it starts to turn back up. You would look for that tennis ball action that I'm talking about, and if it doesn't materialize and it keeps drifting off, then I would get out of it and cut my loss. But it should find support fairly soon. It's acting really well.
Yeah.
DG, of course.
Yeah, let's actually jump to Burlington. You guys had a lot to say about this one.
Yeah, you can't see it. You can't see that here right now on this chart, but because it doesn't have today's data. But it tried to come out into new high ground today, but pulled all the way back in and closed right on the low. So again, it looks like the retailers got a little heavy today, but this one, has all the characteristics. Has made a fairly good move though since the IPO base. We don't have time to talk about that, but I was buying it off the IPO base.
Yeah, the thing about this and the fact that it reversed today is very characteristic of very tough markets. But as long as this it holds up, doesn't break down, continues to form bases, this could be a candidate of if and when the market starts turning, that this could be a leading stock. Now, it's had a long run over the last couple of years, but the way it's setting up, it looks like it wants to have another move. The other thing that you'll see down at the lower part of the chart is that the earnings are actually due in 7 days. So you have to be careful buying this heading right into earnings. And because you're not going to have any cushion unless the stock takes off in the next few days.
And Arusha, look at the numbers. EPS ranking 99, group relative strength rating A, SMR ranking A, accumulation distribution A minus, composite 99, timeliness A. I mean, it can't get any better. So it meets all the criteria. Now it's just a matter of whether it's sustainable or not, and whether you're going to get a buy point.
Yeah.
Let's move through a couple more. Let's go to Microsoft, guys. This one was also looking pretty interesting.
Yeah, I would.
Yeah, Microsoft.
Look,
go ahead.
Yeah, well, I would say that this is, again, another technology stock that's starting to have some problems. Look at how large the volume is as the stock has come down since the beginning of October, rallied back up through its 50-day, and now then rolled over again. And it looks like the volume has picked up 2 days in a row. So I would be very careful of this. It hasn't completely broken down, but it's having now where the stock has been above the 50-day for the last 6 months is now looking like it's starting to live below it. Still above the 200-day, so the longer-term trend is still up, but it might be starting a topping out formation here.
Yeah, I'm a little bit more positive on this particular stock, and I'll tell you why. But now, again, I still have to see it shape up here. It's definitely, it's getting close to D-Day here with this name. If it starts breaking down from here, it's going to look ominous. But we don't have a weekly to look close, but the weeklies, it closes up in the upper. Yeah, you can't really see it there, but there's closes in the upper range on the weeklies. So it looks like, and it's the first time it's pulled back to the 200-day since it came out of a large base. So this one is, to me, is one of the FANG-type names, if you will, that has held up pretty much, better than any other names. It corrected just about the same percentage-wise with the market. So I still want to see it set up here on the right side. I actually own a little bit of this right now, but we'll see if it doesn't work out here, starts coming off, I'll just get out of it.
Okay, guys, it looks like we are running out of time here. So we wanted to bring Jonathan back on to the webinar.
So you've seen the Wizards of Wall Street show you the impact and power of how they use Mark Smith. If you want to take advantage of this same tool, and remember, it's 4 weeks for $24.95. Give us a call, 800-831-2525, or go to investors.com/wizard. That's 4 weeks of Mark Smith for $24.95. That's over $120 in savings. And you've heard both Mark and David talk about how powerful it is and how it helped them in their career. So give it a shot. Give it a try for a month. So some final thoughts. We had over 1,000 questions. There's a lot of questions. We did our best to answer as much as we can, but the webinar will be archived on investors.com by tomorrow, and we will post all the questions and all the answers on investors.com/wizardsqa. So if any questions or concerns, give us a call, 800-831-2525. Gentlemen, do you have any final thoughts?
Final thoughts.
Yeah.
Go ahead.
Yeah, go ahead, Mark.
It was good to be here, and wish we had more time. But I think we did a good job of giving some of the highlights of some of the great tools that we have here to use with Mark Smith. Of course, the program is much deeper than what we went into, and it's just a very powerful tool. And you guys already know how much I love it. So it was great to be here, and I wish everybody the best of luck.
Yeah, and I would add to that, yeah, this is, to me, I wouldn't be able to invest in the market if I didn't have this product, because it just gives me all I need in a very quick snapshot. And the last thing I would like to add to your knowledge of the markets is that study your mistakes. That's where you're going to learn the most. If you do a post analysis on the stock that you've bought and sold, and especially the ones that you've lost on, that do an analysis and see where you went wrong, and that's where you'll probably improve your investment results dramatically. And I hope Mark has a good time tonight answering all 1,000 of those questions.
Thank you both for taking the time out of your very busy schedules to help educate our clients. I know I took 2 pages of notes on the call, and I can't wait to go home and watch it again to learn. So thank you, gentlemen, for taking the time, and hopefully we'll do this again.
Yeah, thanks, guys.
Okay.
Happy
thank you very much. Okay, bye-bye.